So let's get back to our question of the day. European luxury or US tech? Bilal Hafeez, Macro Hive CEO and head of research, joining us now on set. Bilal, I guess this kind of boils down to the question of the United States or the rest of the world. And I'm hearing a lot of strategy meetings are kind of dealing with this question right now. European luxury is kind of emblematic of maybe better valuations, of potential higher growth rates, and a story for 2023. US tech's already been dinged up, but does it come back? How do you see this debate?
No, I think it's a big debate, and I think it won't be resolved easily. My bias, though, will be that international will probably outperform the US over the course of this year. So if I have to lean one way or the other, I'd lean more towards European luxury than towards US tech. I think what also helps this is the fact that China is reopening as well. And to some extent, the story of the past 2 years has been China, the China lockdown and China underperformance, which has dragged down the rest of the world and helped the US. Now we're seeing the reverse of that going forward.
A lot of the CEOs that we're talking to are saying, and we just heard it from Ed Ludlow, we talked to the CEO of Rolls-Royce just a moment ago, still talking about China being very fragile. Can we bank on China?
Well, I think at the moment, what we have seen over the past 4 or 5 weeks is that China's surprised to the upside constantly. So in terms of the restrictions, they've eased them more than people thought, given the increase in death rates. They've also increased the stimulus programs of various kinds as well. So just over the past 24 hours or so, they've introduced some additional fiscal stimulus measures, as well as easing some of the constraints they had on the property sector. So my bias for now would be, although it is fragile, all the mood music from China is that they are really pushing hard on growth.
Are we going to see European valuations coming up, or do we, just back to the comparison with the US, or are we just going to see US valuations coming down sharply?
Yeah, that's a good question. I think my general view would be, I think we will see US valuations come down further, but I think also European valuations may also struggle as well in that context, because there's a strong beta to that. The bigger question for the US is earnings. Last year we saw significant derating of US stocks and global stocks, but we didn't see earnings fall that much. So that's really the larger question, whether we do see finally the big earnings drop that many people are anticipating.
Yeah, and you're definitely seeing a reaction to the downside if you have to do something like cut your margins or whatever, like we saw with Lululemon. Bilal, what's the best way to express the view that you just laid out? Because, for example, there are tons of shorts in the dollar, right? Everyone kind of feels we're going to get a weaker dollar. The technicals look like a weaker dollar. How do you express that the best that's not already priced in?
Yeah, I mean, I think my sense is that the China story has not been fully priced in, at least my conversations with investors around the world. So my bias will be to push harder on the China side. So if one had to express a dollar view, it would be to sell the dollar against Chinese renminbi. So dollar China could fall further. Perhaps Australian dollar could do well, although that's becoming more of a consensus. Then on the equity side, Chinese stocks, Hong Kong stocks could outperform the rest of the world as well. So I'd probably lean a bit harder on the China side, because I think there's a lot more divergence of views around that.
Do you like selling the dollar, though? Or is that already played out?
I think right now I probably would like to sell the dollar. I don't think it's necessarily a long-term trade, but at least tactically right now, I think this is a good environment to sell the dollar, partly because of the China story I already mentioned, partly also because the market is really pushing hard on the end of the Fed hiking cycle, and the data, at least so far, has validated that view.
You guys have always had a view that the Fed goes significantly higher than the rest of the street has. Are you now having to review that? Are you now rethinking that? Where do you think the Fed ultimately tops out?
Well, we're still holding on to that view, that aggressive view that the Fed will end up raising rates to 7 or maybe even 8%. Where we have changed our view somewhat is that our view around inflation, where we thought inflation would be stickier for longer, we now do think that Q1 could see softer inflation as a sort of continuation from December. But we do think it will start to stabilize, if not pick up a bit, in the second half of this year. So in the end, the Fed will end up raising rates to 7 or 8%. Similar to what we saw in the early 1980s, where the Fed raised rates sharply, they eased somewhat, then they hiked rates again. It's very unusual for us to have a phase where you have an inflation spike and then for it to end just like that.
So, Bilal, in that scenario, what bursts? Like, where is the money that is at risk the most in that kind of scenario?
Well, I think in that scenario, I think it suggests equities have further downside to go. But the larger risk, I think, would be private markets, I think would be one. Another would be credit markets as well. Both those markets, both private and credit, haven't really suffered as much as some of the other markets. And so when we do get the next sort of big move up in Fed rates, then that would be an environment where, one, is the funding costs of all of these trades sort of become more expensive. Then on the other hand, you start to focus a lot more on hard landing as well.
There's increasingly a view that the ECB is going to be more hawkish than the Fed this year. Is that wrong from what you're saying?
Well, it sounds wrong, but I think right now, at least the tone from the ECB, at least in Q1, will be more hawkish than the Fed. They'll right. Core inflation has been higher, has picked up, unlike the US, which is falling. So they will sound more hawkish, but in the end, the ECB will hike rates to maybe 3.5%, maybe 4% at most, whereas the Fed is already above that. So in terms of levels, the Fed is for sure more hawkish than the ECB.
If inflation comes, though, back into the US, is it not come back then in the UK and Europe, for example?
Inflation, yes, it could come back in Europe as well. The difference between the two is that the US, the overall US economy and domestic demand is in a stronger position than the European picture. Moreover, the energy picture in Europe is stronger as well in the US compared to Europe. And so what Europe has really benefited a lot from recently, from the growth side at least, has been a mild winter and then a moderation in the energy picture. But that could easily change in the next 12 months.
You've talked as well in the past about your love of cash.
Yeah.
Does the love of cash continue?
Absolutely. If I had to pick one asset class, it still continues to be cash over other asset classes. We have to also remember that if you look from, say, the mid-1960s up until the early 1980s or mid-1980s, cash outperformed equities and outperformed bonds. So when you go through these periods of inflation, lots of geopolitical shocks and so on, cash tends to do quite well. And with yields now at 4.5%, 5%, that's fairly sort of attractive levels. So my bias would be for cash. There are some tactical trades you can do, like long China stocks and so on. But if I had to have a core asset to be long, it would still be cash.
I love this. It's like rapid fire to Bilal. I love it. It's like a tour around the world. Talk about geopolitical risk for a moment. What was your take on what happened to Brazil over the weekend? And I'm wondering sort of how you think about that, how you play it, how you sort of hedge something along those lines.
Well, I think, number one, it shows that transitions after elections are becoming more challenging. We saw that, of course, in the US, and now we're seeing that in Brazil as well. That said, my bias is that Lula will be president, will retain control of the government, and retain the election result. And so when you have these types of events, any sell-offs of Brazilian assets that get triggered by these sorts of protests, my bias would be to fade them and to buy Brazilian assets in that scenario. So these are more kind of one-off incidents, I think. And the overall system, I think, in Brazil is still robust enough to look through these sorts of things.
Is that part of your China trade? Or is that...
It is part of the China trade. It is also part of a view that Lula ultimately will be more conservative on the fiscal side. So there's a lot of speculation right now that Lula will allow fiscal targets to slip, perhaps with some constitutional changes, but we think ultimately he won't go that far, partly because he's already seen Brazilian assets selling off around that speculation. So part of it is China, part of it is fiscal conservatism.
Biggest tail risk, biggest conviction trade for this year? What do you think they are?
I think the biggest tail risk, I think right now actually would be that the Fed doesn't cut rates this year. That I think is the biggest tail risk, because everybody is really positioning their portfolios around the Fed easing in some form or another. Stocks are up a lot, largely because the market's pricing for Fed easing, and when this dynamic of bad news is good news. So that's probably one of the biggest sort of tail risks, I think, now. In terms of other risks, one is private markets, I think, are really under risk here in terms of how they've valued their assets. I think there's significant weakness there going forward.
And cash is the conviction.
Cash, I think, is overall
is the conviction trade.
The overall long,
Bilal, great to catch up. Thank you very much indeed. We look forward to seeing you throughout the rest of 2023. Bilal Hafeez of Macro Hive. This is Bloomberg.